Dan has been gracious enough to come back and do some follow-up with us. He's going to answer questions, any questions we had from last week or any questions that came up during the week that you wanted to ask. Again, Dan is a corporate lawyer. He deals with corporations, contract law, and other things that he'll share with you, okay? So we're going to start our meeting. Ed, if you just want to, if you just want to introduce yourself. If you have any questions, just give me 1 second because both our mics are on. I'm going to shut my mic off and you'll be able to hear him, okay?
Yeah, so just as a quick summary or recap, I am a corporate commercial lawyer. I've been practicing corporate commercial law exclusively, I guess, for just over 15 years now. And my practice involves both working with startup companies or startup businesses and established companies from the initial stages of incorporation right through to estate planning or transfer, or through the whole life cycle of the company. So I have experience with a variety of different companies in a variety of different industries, and I've been doing that, like I said, for just over 15 years.
And trusts and how trusts work, real estate or even estate planning.
Sorry, I didn't hear the question. Your voice faded off for a second.
Trusts. Setting up a trust.
So part of most corporate commercial lawyers' practice would include setting up trusts. So quickly, what trust is a word that describes a relationship in our legal system, that relationship being where one person holds or has title to property for the benefit of somebody else. And trusts are used in a variety of different situations. I mean, there are literally courses taught on the topic of trust. So, I mean, the topic of trust is bigger than this phone call or a series of phone calls. In fact, I went to law school at Western University here in London, Ontario, and the trust course was a mandatory course. There were only back then, I believe, out of the whatever number of courses you took there, I think there were 6 mandatory courses. One of those mandatory courses was trust. Trusts are used in wills, trusts are used in commercial transactions, trusts are used with estate planning, trusts are used in mergers and acquisitions. There are countless types of trusts. There are trusts between spouses. So to talk, unless there's a specific issue on trust, the sort of from a 10,000-foot level, what you're talking about, what one is talking about when he's talking about a trust, is again characterizing a relationship where one entity or one person has title to property for the benefit of somebody else. So, for example, and this isn't the topic of discussion during this call tonight, but for example, in the wills contest, in a wills and estates contest, the executor of the deceased would have title to all of the deceased property, legal title, for the benefit of the beneficiaries, those persons named in the will to receive the property. So that's one type of trust amongst a variety of different trusts. In the real estate investing context, where you often see the trust relationship used for the benefit of a purchaser or prospective purchaser is to include the trust, to characterize the purchaser as one of a trust relationship. And what I mean by that, and I discussed this last week, I think it was last week, and so I'll be brief, and if there are any follow-up questions, I think they're typed on this whiteboard here, so I'll try to keep looking at the whiteboard to see if there's any questions. But where this trust dynamic, where this trust principle of our legal system can be used in the real estate investing context is when an individual has decided to submit an offer to purchase a property, they have a choice when they're filling out, usually it's one of the OREA forms, or it could be some other real estate form, or it can be an offer that you draw up yourself. One has to indicate who the purchaser is, right? And so the purchaser could either be Adnan, if I'm looking at purchasing this parcel of property, or in order to insulate myself from potential liability, which is an exercise that all, I think, prudent owners of any stripes, whether they're investing in real estate or otherwise, you're always trying to insulate yourself personally from liability. What I might do, rather than inserting my name, rather than having Adnan as an individual a party to the agreement, I would insert Adnan in trust for a company to be incorporated. What does that do? Quickly, what that does is, somebody's asking me to speak up. Can everybody, Sam, can you hear me? Can everybody hear me? I'll try to speak up a bit. So going back to what I was saying before, if Adnan is the purchaser in a purchase agreement, and if for whatever reason Adnan cannot close that deal, maybe he failed to secure financing, maybe something came up, maybe during the Adnan's due diligence of the property he decides not to purchase the property and is therefore in breach, then the vendor of the property, the seller, would have a claim against Adnan and could potentially sue Adnan. And if the seller sues Adnan for breaching the agreement of purchase and sale and not closing, then Adnan's personal assets, his house, his cars, his investments, any money in the bank, anything would be available to the plaintiff if the plaintiff was successful. If the vendor was successful, Adnan's assets would be available to satisfy any award that the court would, any judgment that the court would award. Okay? Now, in order to avoid that, and somebody's saying the audio is coming and going. Sorry, I'm trying to hold the microphone close to my mouth, so I hope that helps. If it doesn't, let me know. Anyways, if in order to avoid the risk associated with, okay, great, thanks guys. In order to avoid the risk associated with Adnan or any individual, I'm just using myself in this example here, and by the way, I don't normally talk about myself in the third person, but anyways, in order to avoid liability, personal liability associated with failing to close the deal, thereby breaching the contract, what I could have done when I entered into the agreement, and we see this all the time. I've had years of experience with real estate investing. We've seen this all the time in real estate acquisition agreements, and I've acted on both sides of real estate deals, whether for the purchaser or the seller. What I could have done, rather than inserting my name as the purchaser, I could have inserted Adnan in trust for a company to be incorporated. What does that do? Again, I know we don't have much time, Sam. I got till 9:20, so I'm going to try to speed through this. So what does that do when I say admin and trust for a company to be incorporated? That means that right there is in law a characterization of a trust relationship where admin has title, legal title, and admin is a party to the agreement for the benefit of some company to be incorporated that hasn't been incorporated yet, but that will be incorporated in the future, right? And in the future means at some point before the closing date. So if we enter into the agreement today and the deal is supposed to close in the end of April, and the deal says that admin and trust for a company to be incorporated is purchasing the property, that means that admin on or before the closing date, the end of April, will have to incorporate a company who will then be the purchaser of the property. The benefit of inserting this trust language, again, it creates this dynamic where you've got one party who holds legal title, in this case admin, and the other party who holds beneficial title or who really benefits from the asset. In this case, the asset being the contractual rights, the contract, right? The benefit of characterizing the purchaser as a trust relationship is that if the deal doesn't close for some reason as a result of the purchaser, if the purchaser doesn't secure financing or there's as a result of due diligence, there's some environmental contamination that is revealed, or for whatever, there are myriad reasons why a deal might not close, right? In that event, then admin personally would not be on the hook, right? Because admin's holding the agreement in trust. He's the trustee. I would be deemed to be the trustee for the benefit of this company. The party who would be deemed to have breached the agreement if the purchaser doesn't close is this company to be incorporated. The company to be incorporated, and you have to incorporate a company and go through the expense associated with it, but your personal assets, the purchaser's personal assets, the individual's personal assets, in this case admin, my house, my car, my investments, anything like that, would not be available for to satisfy any damages award that a court might order in the event that the vendor sued me in court, right? So in the event that the purchaser is admin and trust for a company to be incorporated and the deal is to close at the end of April and the deal doesn't close, the seller's lawyer would write a letter to the buyer's lawyer and say, hey, listen, we're suing you. You breached the agreement. You said you were going to close at the end of April. You didn't close. We're suing you for the losses we suffered. In all likelihood, the buyer's lawyer would send a letter to the seller's lawyer and say, listen, your claim might have merits. You may have a strong case. You're right. We said we were going to close. You're right. We didn't close. But as you know, the purchaser in this agreement, the party with whom you contracted, was a company that we just incorporated, who, by the way, has no assets, no rights, and therefore, from a practical perspective, what happens is there's never a lawsuit, right? No right-thinking lawyer would ever tell a seller, sue this barren company, sue this company that has no assets in it, because if the seller did, they could go to court. They would likely win because the purchaser did breach the agreement by not closing, and then the seller would have this pretty little judgment stamped by the court saying the plaintiff owes you, the plaintiff being the company that was incorporated, $100,000 or whatever the number is, and then the seller could go and try and recoup that cash from the shell company, but there's nothing there. I hope that wasn't a long-winded answer to the question. But that's the benefit to be gleaned from using a trust relationship in the real estate investing context.
In the legal realm, at least, of setting that up where you move something that you already own into a corporation.
Yeah, and I mean, I'll apologize in advance because I can't help much. This is really a tax-related question. So, I mean, I'm a lawyer. I give legal advice. I do not give tax advice, and that's simply because I don't have the expertise or experience. I know some tax. I mean, a lot of my practice involves tax, but I leave that to the experts. So let me answer it this way. Strictly speaking, from a legal perspective, there's absolutely nothing to preclude you from doing that, right? From a tax perspective, and this is a question best asked of not just an accountant, but a tax accountant, there are a couple of issues that you have to consider, right? One is there any capital gains, right? Capital gains being, generally speaking, the difference, half the difference of the increase in value from the between the purchase price and the sale price, right? So if you bought something for $100,000, if you bought a capital asset for $100,000 and you sold it for $200,000, you have $100,000 of gain. Half of that is considered a capital gain, and there's tax payable on that. So you have to consider that. You also have to consider land transfer tax. And land transfer tax is an amount payable on the consideration deemed to have, the consideration paid on the purchase price. Now, you'd have to ask a tax accountant about this, but most of the times the land transfer tax is relatively easy to avoid, I understand, because you can set out any consideration you want and the purchase price. You can set out $1. You can set out for natural love and affection if a transfer is, for example, between spouses. So I know, for example, very recently we did a deal where a husband and wife owned a house jointly together, okay? Now the husband transferred his share of the house to the wife, right? So the house went from being in both names to being only in the wife's name. Now anytime there's a transfer of real property being land or anything on land like buildings, there's the potential for land transfer tax to be paid. Land transfer tax is payable on whatever value was any consideration, the value of what was used to pay for that transfer. In that case, the wife didn't pay the husband anything. It was deemed to be natural love and affection, and you can't pay, land transfer tax on that. One other thing I would just caution people, and again, this is a tax question, not a legal question. From a legal perspective, there's nothing to preclude you from doing. From a legal perspective, sometimes it makes perfect sense to insulate yourself from liability, right? You want it out of your name, you want it in the corporate name, to insulate yourself and your personal assets from liability, right? So that if everything, if the real estate market, and I don't expect it will, but if the real estate market goes to hell, if you've got your real estate assets owned in a company, generally speaking, or company or companies, it could be plural, generally speaking, you're okay, your personal assets are insulated from liability. One caveat to that is, and this has nothing to do with real estate investing, although it does have to do with real estate ownership. If you own, if you own a house that you're living in, all right, you normally, and I'll explain in a second why it's normally and not absolutely, you normally don't pay any tax on the sale, on the increase in value of the house when you sell it. So for example, I know somebody who bought a house in around 1972. They bought the house for $27,000. They lived in the house for 40 some odd years. They then sold the house for about $750,000. So the increase in value of the house was about, let's say, $750,000, right? $725,000, sorry, about thereabouts. The exact numbers don't matter. Okay. Because there was an increase in value, the general rule in the Income Tax Act is anytime you sell something for more than what you paid for it, that increase in value, that gain is taxed, either as income or a capital gain. In this case, there was no tax payable. In this case, it would have been capital gain, because this house that was purchased in 72, I believe it was, and sold 40 years later, was always used as the owner's principal residence. And by principal residence, I mean the residence most often occupied by the owner. The principal residence, the distinction between principal residence and some other residence only matters if you own more than one home that you reside in, right? Most people don't own more than one home that they reside in. Some people do. So for most intents and purposes, and for most people, the home that you live in, okay, you get to keep the gain in value of that home tax-free. Whereas if this person that I'm talking to you about had bought an investment property in 72 for $27,000 and sold it 40 years later for $750,000, they would have a gain of about 725 grand. Half of that gain would be deemed to be a capital gain and would be taxable. The reason I bring all this up, and these are tax-related questions, and I'm not here to give tax advice, and if any of this matters to you, go talk to a tax accountant. Don't take my word for it. But the reason that I brought this up is to let you know that although in some situations it does make sense, or it may make sense to transfer real property, houses or buildings or land, from an individual's name, from a human's name to a corporation, you would be hard pressed to find a situation where it makes sense to do that for your principal residence, because if you transfer your principal residence out of your name to a corporate entity, you then lose the ability to insulate yourself from the capital gains, right? You don't have the right to that principal residence exemption anymore.
Excellent.
Because the principal
just,
residence exemption only applies when the owner of the property is living in the house. If the owner of the property is the corporation, they're not living in the house, it's the individuals, right? So the short answer, I guess, Sam, is yes, you can do it. You can transfer back and forth from a legal perspective, no problem. But the real considerations here are tax considerations. So then, how would the buyer who's get their 100 grand? Well, they just wouldn't. Who is this? Audrey? Audrey, you just wouldn't. I've had lots of clients who have sued and were not able to realize. If you sue Adnan, if Audrey sues Adnan for $1 million, and Audrey wins, and Adnan has zero assets in his name, she's not getting any money. She's just not. She's going to get a pretty little judgment from the court, stamped by the court, and she can, put it in a frame and put it up on the wall and look at it. But if there's nothing there, there's nothing there, right? And this is all perfectly legitimate liability creditor proofing. This is all perfectly legitimate.
Sorry about that. Yeah, I think so. Any other
many companies do this,
good. Okay, good.
right?
Any
So,
other
I mean, that's one of the first questions you ask before you sue, and you go through the expense of suing, is if we win, can we realize on our award? All right, I think that's it, right, Sam?
Yes, thank you very much. I really appreciate it. Thank you very much.
Yeah, I've got to run, Sam. If you could, whenever you guys are done, if you want to put my my contact details in there, I'm happy to answer any other questions that anybody has.
Put information.
Otherwise,
Adnan's information at the bottom there. You're welcome to grab that and reach out to him if you have any questions that you want to set up a trust or you want to set up some corporations. He'll be able to do that for you and help you set up your corporate structure. Also, obviously, very learned, very accomplished in contract law. He's a partner actually at Siskins, a great law firm across Canada, at least in my view. And if it's an interest of you and you don't have an attorney already, if you're happy with what you have, just stay with what you have. If you're looking for something else, definitely you can reach out to him. That's totally up to you, your choice. You need a corporation for doing a flip. Well, if you flip a property, obviously there's a liability issue, right? And Devin, that's an accounting question. What's the best benefit for me? Should I leave it in my own name? If you're because that money that you profit from it, that's going to be taxable against your income either through capital gains or earnings. Again, that's better an accounting question than because the liability issue, Devin, the liability issue is there any liability in a flip? Well, while you possess it, while you own it, or the corporation owns it, there's going to be liability, right? Something could happen, and there could be a lawsuit, frivolous or otherwise, that would create some risk. So it's really a combination of safety, putting it in a corporation for safety against that liability, and the tax implication would be more of a question between personal, is there other income that you have or don't have, and the corporation itself, the impact on it financially. I wonder how you can protect your personal assets from suing or so. So, Michael, the question of protection, I think that's that Adam was talking about that. Anything in a corporation is going to have a shield of liability. Now, is it exhaustive or complete? I'm not the one to ask. Adam would be the one, but typically you're shielding yourself against liability against those assets if something goes wrong. So that would be depending on what it is that you want to protect. But that's why I was asking the question of moving a property, personal property, into a corporation and the benefits to that for you. And that's why Adnan stopped short a little bit and said there's a tax question there. And there's things you can do. You can defer some costs, and with a good accountant, you can structure it to maximize the benefit of that chain. But again, making the point that if it's not a personal residence, it's not subject to tax, versus if you sell your personal residence at some future date, there's no personal tax. So that's a legal and accounting question, really. So you will pay capital gains if you properties. The only one really shielded, at least for this conversation, is your personal residence, the benefit of owning your own property in your own name. They don't tax that, and if they did, I don't think anybody would own a house if they tax that, because that would be a negative yield for a lot of people. Okay, let's see. Can you have a corporation that does property and provide a professional service? So you can do anything inside a corporation that you want. I mean, we just going back to the this setup of why. Okay, so when we do this and we set these up, each one of these, so that's the holding, the consulting, and then we have the real estate. So you don't have to have three companies. We just separate them for liability and tax purposes. So these two companies are not attached. They're not attached. The holding company is the shareholder here, and the shareholder here, controls these two, right? And you're up here, you control this, okay? So, and there's lots of variations, but the providing a service could be done out of here, while ownership of the property is kind of done over here. But you can do anything you want through a corporation. Active corporation versus a non-active corporation, or passive. These are non-active corporations. This holding company, real estate company. So you're going to see taxes that are higher for these two versus a service. And this could be a property management. This tax is going to be lower because it's an active company. But you will pay capital gains. Okay, you got that good? Okay, that was a good question. Thank you for asking. Okay, good. Any other questions? So next week, just as we wrap up, unless there's any other questions, I'm happy to have them. That was a very nice piece to have. Three corporations. At what point? Okay, let me read that. At what point is it worth it to use this model? I think that it depends, on what you're doing and how you're doing it. But really, the real estate company, when we have real estate properties, right? If we have no properties, it's not necessarily the best idea to open up a corporation with nothing in it. Again, tax question, but from my knowledge, why having that open at all without a property doesn't make a ton of sense. The holding and the consulting could be, created, so you can start building some expenses that can be written off against earnings in this corporation. Again, it depends, what you're doing and how you're doing it. And again, that would be, legal and accounting question. But you could set up the holding and the consulting. You could start with that if you're moving forward and making things happen. Can I ask about legal? Can I ask about legal? Can you expand on that, Michael? Nina, okay, that makes sense. Thank you. I thought about incorporating for a while for my profession, but now probably will make sense for the real estate corp component as well. Yeah, sure, you could do that. I mean, yeah, for sure. Might be a good idea to separate your personal, if you have a business or a corporation that provides a service, to separate that from this model here completely. You could have a holding company with that corporation separated from it. You could do that too, or just separate it altogether. Again, we're setting up these corporations for the benefit of taxes and liability, right? It's asset and tax protection. Asset protection and tax is what we're doing. We're trying to, pay the appropriate tax, obviously, based around the corporations, but reducing the impact on the growth that we have, right? And that's all legal and done with the right professionals. It's what you do, right? It's what you do to accelerate your own personal growth in your real estate uh, dynasty as you build that up. The real estate corp and the holding corp both are taxed very high. Is that right? Well, higher. I want to say, Diana, higher because they're passive, right? They don't do anything. There's no activity there. It's the consulting company or property management company that would be the active company, and it's taxed at a low rate because it's an active company. So yes, they'd be taxed relative to the active company higher. Yes. Good to hear from you. Nice to see you back. Okay, Diana, did you want to share something about you emailed me, or is that something you just want to email me? Because you said you emailed me about training or something like this. It's totally up to you. I didn't know if you wanted to share it. I want to call you and talk about it. Yeah, sure, no problem. That's no problem. That's no problem. Okay, here we go. Okay, I'm buying a new house, a new home, but instead of buying a new higher debt, is there a creative way to second mortgage on the current property and rent it, then put the money in the new property, knowing that more than 50% of is equity in the current home? Can I email you to pick your brain? Yeah, absolutely, Michael. You can send that to me. Yeah, the more detail you give me, the easier it is for me to kind of give you my view. But obviously, I strongly suggest folks. Um, yeah, I mean, there's some benefits there. I'll tell you that with the cut in Canada's bank rate, the Canadian bank cut rates by half a point today. We should see the banks follow, so we might see mortgage rates drop a little bit in the coming months, and we'll probably see some aggressive. Um, I wouldn't doubt if we saw aggressive ads about refinancing the house or changing banks for mortgages. Uh, there'll be some of that, I think, because of the drop. So it'll be interesting to see what happens. We might also see a bump in real estate values um, because of the new liquidity and lending. That because of those interest rates, so your payment will be less, right? That's the idea. P.S. For all of you peeps looking to purchase a condo as a rental investment, I just sent a few emails to my clients who purchased a year ago to congratulate them as those properties appreciated 100,000 in a single year from 450 to 550. Well, that's amazing. That's amazing. If you don't know, Nicola is a realtor. So, is anybody interested in his contact information? He's a realtor. Um, Anybody, if you want to reach out to him to talk about his areas, um, that's something that he does actively. And if you're interested, definitely let me know. Okay. Why not just have the consulting company and the real estate company only? Because if this separates the real estate from the active company, right? And again, right, this is something, Diana, you want to talk to an accountant, the benefits of that. But the liability of this property is exclusive to this real estate company only versus creating a liability in this active company. Okay, so there's a liability issue. The tax implication is that the taxes would be for the active company less, but this would still be subject, obviously, to tax when it's sold. So just to give you an example, as this property makes money, it's making money. Uh, the money is brought over here, right, for the consulting company managing the property. So this would the earnings from that real estate property um, legitimately, right, are going to be charged back to the consulting company for managing the property, which will be taxed at a lower rate, uh, as far as I understand. If you put, I mean, technically, Diana, you could have one company. I mean, these names, holding, consulting, and real estate, they're just names. Really, they're all corporations. So if you wanted to put everything together, we're trying to separate liability like we would from houses, different properties. Uh, that would be the benefit of it, is just separating the liability. And there is tax implications that definitely an accountant would be able to tell you better than me. But that's the structure that I've been taught and I use. So, um, the minutia or the specifics that you might be looking for more than that, definitely an accountant or um, Adnan could help us with that. It sounds like Adnan might join us next week. Next week, I'd like to bring on somebody about mortgages, actually. Talk about mortgages and the mortgage system, and what you can do in setting that up. Also, could speak about insurance on the corporation for the shareholder insurance. It's called, if you're doing partnerships, to protect those shareholders uh, in certain situations. So we can talk about that too. Okay. All right. Any other questions before we wrap up? Can I self-promote? We have a deal going on and we give people that are selling their homes free renovations. Yeah, sure you can. What are we talking about, Diane? You have a deal going on. Okay, there. Okay, if anybody's interested, this explains. Oh, that explains it. Okay. Michael, either email that you have for me, they're still same emails. Same emails. Oh, that's good. So Diana, maybe we can have you jump in on a call maybe next week or the following week, depending on time, and you could talk a little bit about that. That's not a problem. I'm totally okay with you folks, promoting yourself and your business on this call. Like, this is absolutely. So if you just give me some time, um, let me know ahead of time, and I'll bring you in like I did Adnan, and you could share about it and talk a little bit about your business and what you're doing. So I'm totally on board with that. If you have a lawyer that you like, or an accountant that you like, or a realtor that you like, and you want to bring them on the call to grow their business and help them out, and they're knowledgeable, I have no problem bringing them on the call either. So everybody understand that? I'm totally okay with you promoting your own power teams. That's totally okay with me. Okay? I'm on board with that. The bigger the network that we create, the better for everybody. Awesome. Okay. So, yeah, absolutely. Absolutely. Okay. Any other questions? Please keep coming with those questions. As long as you have them, I'll keep going. Okay, Nicola, we'll talk to you later, my friend. All right, folks, if you're good, type in yes or Y. Great. Okay, the video's up from last week already up. I'll post this one up in the next couple of days. I want everybody to have a great week. Please evaluate a couple properties this week. Keep things going. Keep moving forward. And as things go, if you keep doing what you're supposed to do, things will work out. It's just a matter of time. Okay, so keep doing the right things, and good things will happen. All right, folks. Have a good night. And you know how to reach me if you need anything. Please reach out to me if you're working on any deals. If you want me to share a deal with the group, totally on top of that. And like I said, please, you can promote your power team. I'm totally okay. Just give me some lead time and we can organize that. All right, have a great week, and I will see you all next week. Just a reminder to everybody: the stock call is at 8 o'clock. 8 o'clock. 8 o'clock, same day. This day, 8 o'clock, same link. If you're interested, you're more than welcome.